What is the role of the custodian in short selling in the securities market? Let's understand this more. Hello, everybody. I'm your learning partner Sushila Hariharan. And if you're interested in a career in investment banking, trade life cycle, corporate actions, and OTC derivatives, do subscribe to my YouTube channel where we provide content centric videos on these topics. So let's understand this. A custodian is a custodian of a client's assets. Okay, a custodian is an entity that is responsible for the safekeeping and movement of assets of the client. In this case, the clients are large pension funds, large hedge funds, mutual funds, insurance companies, high net worth individuals, etc., who individually contribute literally millions of dollars of assets that are managed by the fund manager but handled by the custodian. Okay, so the custodian is a separate entity from the asset management company, but it is an integral part of the financial market space. So a custodian thus is having a portfolio running into trillions of dollars. If you look at some of the largest custodians like Northern Trust, State Street, BNY, etc., they have assets of their clients running into trillions of dollars. Now, sometimes some of the assets are not put to the best of uses, in the sense that they're lying in the portfolio of the client, and the custodian wants to deliver these securities on behalf of the client. So let's understand what happens in a short sell, and then we can understand the role of the custodian. So in a short selling trade, short sell means the seller does not have the securities. Okay, it's as simple as that. So suppose you do a selling of securities or selling of equities on the stock exchange without owning it, it is called as a short sell. So it creates a trading position, that is, you shorted the stock, but you have to deliver the stock to the counterparty, or in this case to the clearinghouse of the stock exchange. That is the basic format of the short selling process. So then what happens over here? The seller has sold the securities anticipating that the prices will go down so that he can do a short cover trade and is able to square off the position. But they might want to hold on to the trading position anticipating a larger fall in prices for a period more than the settlement cycle of the securities exchange on which they have traded. Let me just explain this in simpler terms. Let's say the National Stock Exchange in India, the NSE, has got a T+1 rolling settlement cycle. Okay, the short seller has to deliver the securities to the clearinghouse of the National Stock Exchange within that T+1 rolling settlement cycle, within the deadline of the rolling settlement cycle. Okay, but they don't have the securities. They have short sold with an anticipation that the prices would go down further, and they want to be able to take advantage of that price fall, and therefore they have short sold something that they don't own. So what can the trader do? The trader borrows these securities. Okay, so till now you would have heard about lending and borrowing of funds. Now we are talking about lending and borrowing of securities. Lender of the securities is the one who has the securities, right? So in this case, the owner of the securities is the asset management company, and the entity that's handling the securities is the custodian, right? The short seller is a different entity altogether. So the custodian then wants to check with his client, do they want to lend securities on behalf of the client. The short seller then lends these securities, okay, to the trader who has taken a short position. Is that allowed? Yes, it is allowed, because there would be a master agreement between the asset management company and the custodian facilitating the transfer of such securities from the custodian on behalf of the principal to the short seller. So what does the custodian make out of this? The custodian makes interest income. As long as the securities are lent by the custodian to the trader, okay, the custodian charges interest, typically at overnight market rates. Okay, and this is true because we don't know how long the position is going to last, right? So suppose the trade has taken place on T plus 1, the trader has borrowed the securities, and by T plus 5, they have bought back the securities from the market. They need to return the securities back to the custodian. Okay. So for that intermediate intervening number of days, the custodian will charge interest to the borrower of securities. So over here, the custodian is acting as a lender of securities, and unlike a bank which is lending funds, over here the custodian is lending securities. The borrower is the short seller who has short sold securities that they don't own, right? And for the intervening period of the time that they have short sold the securities, the custodian charges interest income. Okay. But the custodian is not the owner of the securities. Sure, the custodian is not the owner of securities. The owner of the securities is the asset management company. There will be a income sharing agreement between the custodian and the asset management company with reference to the interest income that is earned by the custodian for lending of these securities. So is this a big business? Yes, it is. Okay, it is a very big source of income for custodians to earn money from financing short sales. Okay, and they will have to compensate the owner of the securities, which is the asset management company, for the sale. So thus custodians, without the role of custodians, short selling would be very difficult, because you can imagine the cost of having to find out who has the securities and then to be able to borrow it from them, and thus prevent the trade from going into an auction kind of a trade. So this securities settlements in the short sales is an extremely important role that is provided by the custodian. The custodian, of course, also does other activities like taking care of settlements, participating in tri-party repo trades, safekeeping of assets of the client, as well as collection of corporate actions. But the income that they earn from the financing of short sale trades is significantly high, because really they own almost trillion. They hold almost trillions of dollars worth of assets across countries in different currencies. So with this kind of a large portfolio, they are in a position to deliver the securities as and when it is needed in order to meet the securities exchange rolling market cycle. The custodian, this is almost automated in many of the markets in the world. It's called as an SLBM in some markets, securities lending and borrowing mechanism. In some other markets, it's called as ALBM, assets lending and borrowing mechanism. But all in all, it literally means the lending of securities by custodians to short sellers in order to facilitate the settlement of the trade. Thank you so much for listening in.